Imagine getting paid every month just for owning shares of the company that owns hundreds of hotels across the United States. That's exactly what Apple Hospitality REIT offers investors. With a dividend yield around 6%, a portfolio of Marriott and Hilton hotels, and a stock price that has struggled to gain momentum in recent years, Apple Hospitality REIT ticker APLE is attracting attention from income investors. But is this a reliable income machine or a risky hotel stock disguised as a dividend investment? In this video, we'll break down the business, the dividend, the financials, the risks, and whether APLE deserves a place in a long-term portfolio. Apple Hospitality REIT is one of the largest hotel real estate investment trusts in the United States. The company owns more than 200 hotels and nearly 30,000 rooms spread across dozens of states. Unlike hotel operators, Apple Hospitality primarily owns the real estate. Most of its properties operate under globally recognized brands such as Marriott and Hilton. This is important because those brands provide reservation systems, loyalty programs, and marketing power that help maintain occupancy levels. The company focuses mainly on upscale, select service hotels. These hotels generally have lower operating costs than luxury resorts and tend to perform better during economic slowdowns. In simple terms, APLE collects income from hotels that travelers use every day for business trips, vacations, conferences, and weekend getaways. The key metric for hotel rate is something called RevPAR, which stands for Revenue Per Available Room. RevPAR combines occupancy and room rates into one measurement. For example, if more rooms are booked and room prices increase, RevPAR rises. Unlike apartment rate that sign leases lasting months or years, hotel rooms are rented nightly. That means revenue can increase quickly when demand is strong, but it can also fall quickly during economic downturns. This makes hotel rate more cyclical than many other types of real estate investments. The biggest reason investors buy APLE is the dividend. The company currently pays dividends monthly, which is relatively rare in the stock market. At recent prices, the dividend yield has been around 6 to 7%, significantly higher than the average dividend yield of the broader market. For income-focused investors, that's attractive. However, investors should understand that hotel rate dividends are not as stable as dividends from sectors like utilities, pipelines, or net lease real estate. During the COVID-19 pandemic, hotel demand collapsed worldwide and Apple Hospitality suspended its dividend. While the dividend has since returned, this history reminds investors that hotel rate income depends heavily on travel demand and economic conditions. One of the plus strengths is its balance sheet. Compared with many real estate companies, debt levels appear manageable. The company maintains substantial liquidity and has access to revolving credit facilities if needed. Management has also worked to keep much of its debt fixed rate or protected from sudden interest rate increases. This reduces the risk that rising borrowing costs could severely damage cash flow. When evaluating rate, investors often focus on funds from operations, or FFO, rather than traditional earnings per share. Based on recent results, a pled dividend appears reasonably covered by cash flow generated from operations. Now let's discuss the risks. The first and most important risk is economic slowdown. Hotels are highly sensitive to business travel and consumer spending. When companies reduce travel budgets or families cut vacation spending, hotel occupancy can decline rapidly. The second risk is competition. The hotel industry remains highly competitive, and supply growth in some markets can pressure room rates. Third, investors should remember that APLE is not a growth stock. The company is unlikely to deliver explosive earnings growth. Most of the expected return comes from dividends rather than dramatic stock price appreciation. Finally, hotel rate tend to experience greater volatility than many other income investments. If a recession arrives, APLE could face significant pressure despite its relatively healthy balance sheet. So, is Apple Hospitality REIT a buy? The bullish case is straightforward. Attractive 6% plus dividend yield, monthly income payments, large portfolio of Hilton and Marriott hotels, reasonable debt levels, stable operating performance. The bearish case is equally clear. Hotels are economically sensitive. Dividend safety depends on travel demand, limited long-term growth potential, higher risk than many traditional rate sectors. For investors seeking dependable income and willing to accept economic cycle risk, APLE may be worth consideration. For investors focused on growth or maximum dividend stability, there may be better alternatives elsewhere in the rate market. Ultimately, Apple Hospitality REIT appears to be an income-focused investment, not a get-rich-quick stock. And that's exactly why some dividend investors continue to keep it on their watch lists. If you found this analysis helpful, consider subscribing and let us know which dividend stock you'd like analyzed next.